Good morning. Thank you everyone very much for joining us today for what should be a very interesting session. My name is Caroline Escott. I am the Investment and Stewardship Lead at the Pension Lifetime Savings Association. Before I introduce you to our illustrious panel who are going to talk to us about whether or not active stewardship can have a positive impact on member outcomes, I'm going to go through a few housekeeping tips. So first of all, welcome to all of you, but also welcome to our online audience. So this is a session that is being live web streamed. In terms of asking questions, you can do it in the usual way at the end by raising your hand. You can also do it through the app. If you just click on the session and scroll down, you can ask questions in a much more anonymous way. And for those people who are joining us online, you have the ability to do it through the website as well. And at certain points during the day, I will be going through this and picking up and hopefully not messing up the technology this time round, picking up any interesting questions. So, stewardship. At the PLSAs, you can probably guess from my title, we think that stewardship is an important thing for schemes as long-term investors to be doing. We do believe that good stewardship can have a positive impact for the value of scheme member savings, but of course, seeing as today is also about trying to understand savers' perspectives, we are also interested to explore whether or not talking about stewardship and how your scheme acts as a steward of its assets can actually have a positive impact on encouraging members to engage more with their retirement savings. So before I introduce you to the panel, as I have a slightly captive audience and I can't resist when I get members together in a room asking you a question, I would like you to take a few seconds just to go into your app and to give me your answer to this. It will help us think about how we talk about stewardship. And it's just a really interesting thing to be able to gauge. We'll ask the same question at the end to see whether or not our panel has changed your mind in any way. Good. I can see a few of you looking at your phones. This is the awkward 30 to 40 seconds whilst you wait for people. Ah, lovely. Oh, that's good. 90%. 90% up. It's changing. 8% no. Don't know. Oh, I love this. Real time. Well, it sounds like the panel's job is done, basically. You can all go home now. We don't even need to listen to you. Okay. Oh, yeah, good. You're up for the challenge. Lovely. Thank you very much. That's good. 86%. And we'll move you on. Right, so on the panel today, we have experts in this issue looking at this from lots of different angles. So first we have Anne-Marie Williams, who is Investor Engagement Manager at ShareAction. We will then move on to Robert, who is Head of Asset Stewardship for EMEA at State Street Global Advisors. And as you will see, they very kindly brought along a fearless girl for you all to look at whilst you're listening to our speakers at the same time. Finally, we will go to Kaisie Rayner, who is Senior Manager, Responsible Investment and Fund Development, Investment Strategy and Execution at Scottish Widows, who will give us a little bit of the scheme perspective. So, to set the scene, we have Anne-Marie. Would like to take us away? Thank you.
Morning. It's very nice to be here this morning. I'm just going to set the scene briefly, going to talk as quickly as I can about the new sort of regulatory changes that have been taking place over the last few years, which has really sort of changed the landscape. So starting really with well, maybe the 2014 Law Commission report, but I'm not going to go into the details of that at this point. But highlighting the 2016 LGPS regulations, which talked about authorities becoming signatories to the Stewardship Code and recommending that they publish the outcomes of voting activities. We've also, of course, this year had the proposed DWP regulations, which will hopefully come into effect very soon. And these regulations talk about policies needing to be in place by 1st of October 2019. Trustees of pension schemes must have policies on stewardship activities, including voting at investee companies on environmental and social impact and governance. By 2020, 1st of October 2020, DC schemes will have to publish these policies and report on how they're implemented. The FCA is committed to consult on providers' approach to ESG and stewardship in early 2019. That's for contract-based schemes. And then beyond that, over and above that, we have the Shareholder Rights Directive, which, despite Brexit, whatever happens with that, the UK is planning to implement this directive, and that's due by June 2019. And that is specifically to encourage long-term shareholder engagement, stewardship, and transparency. I've got here, given to me by my colleagues on my policy team at ShareAction, a very long explanation of all the sort of requirements and provisions. The investors have an engagement policy that describes how they integrate shareholder engagement in investment strategy, including how they monitor investee companies on relevant matters, including strategy, financial, non-financial performance and risk, capital structure, social and environmental impact and corporate governance, conduct dialogue with investee company, exercise voting rights, and so forth. So that's all very, very detailed information. They also specifically require annual disclosure of how these policies are implemented, how the votes are cast, and what investors' arrangements are with asset managers. So obviously there's a lot of really new regulation in this area that means that it's a really important kind of area to highlight for pension schemes. And in many cases, obviously, this is the first time that these requirements have come into place. We feel that this stewardship, as a kind of part of general kind of ESG integration and general sort of integrating of ESG into investment decision making, we feel that it's a particularly good opportunity to engage savers. We wrote at ShareAction, we wrote a report earlier in the year called Next Generation Pensions, in which it talks about the fact that ESG and engaging with companies is a really, really good, very powerful tool to engage savers on real world issues and establish an emotional connection between savers and their money. And I've heard a lot since I've been at the conference about, you know, the inertia that exists in the pension industry and different ways in which we can do to address that. And we feel that this is one really, really important and powerful tool that's not really been used yet. And surveys have shown, for example, the DWP consultation earlier in the year showed that 94% of people want their pension to be invested responsibly. The recent Nest Responsible Investment Report highlighted, I think, 88% of people really, really care about responsible investment. I think 47% said very strongly that they did. So we feel there's a real appetite for people to engage with this. And obviously, by talking about active stewardship and engagement with companies, you know, you can use this in a way to engage people really early on in their journey. And we feel this is really important, that savers are engaged early on and not just, you know, 5 to 10 years before retirement. Because we feel if they're engaged early on in the journey, then they'll obviously start saving earlier on, and you'll get, you know, higher contribution rates, which makes a really, really big difference when you're looking 20, 30 years. So, yeah, I won't go on anymore because I've probably gone over my 5 minutes, but I'm happy to expand on all of this later. I'll take questions. So, let's grab my pen.
Thank you very much, Anne-Marie. Out of interest, you know, we have all these stats about people really wanting to reflect their values in their savings. Do we have any stats as to whether or not they actually do so, they put their money where their mouth is?
That's a really interesting point. I suppose at the moment there haven't been so many. I'm just going to look because I've got a whole load of statistics here that I jotted down from the report.
That's what we like to hear, evidence-based talks. Very good.
I think at this point it's more people saying what interests them. Mm-hmm. I think a lot of the problem is that, you know, people are very interested in a lot of sort of social and environmental sort of impact issues, say like climate change or living wage or something like that. But often there isn't great signposting on the websites of pension providers. So even if they're interested in these things, they wouldn't know how to find a fund that address those issues. And we find that time and again, savers say to us, well, we want to invest in an ethical fund or so forth, but they don't actually know the name of the fund, and they can't find it, they can't navigate their way. So I think that's a really big issue.
Yeah. Okay. Thank you very much. I'll go over to Rob to give us a little bit of a practitioner's perspective.
Thank you. So it's a great pleasure to be here this morning. So I'm just going to speak very quickly, 5 minutes or so, on State Street's approach to stewardship. So as a global index provider, essentially we are a permanent holder of capital. So once a company goes into one of our index products, we can't sell it. And so for us, engagement is a core part of what we do. It's not a nice to have. It's kind of central to our stewardship program. And our stewardship program is fundamentally risk-based as well. So, of course, because we can't sell companies once they are within the index, what we can do is raise the quality of the index through our engagement and voting. And so our stewardship program essentially encompasses 2 points. Is a sector approach, a thematic approach, and of course that then leads to voting outcomes. So our sector approach tends to follow 3 sectors annually. That means over a 5-year period we cover off all of the different sectors that we would have exposure to. Our thematic approach includes the kind of global issues that we think are impacting businesses. Of course, gender diversity is one of those, and as you can see on the stage, we have our Fearless Girl statue, and I'll come on to that a little bit later. But we also look at things like climate change, water, and sustainability. And our kind of thematic approach are really issues that we want to look at over a 1 to 3 year period. So these are the issues that we think are challenges for global businesses that we want to be following up over this time frame. And then that leads to our voting focus, which incorporates elements of our thematic approach. And so what we mean by that is that we will take voting action on things like gender diversity or climate change where we feel that companies are not listening to us. And so, what does that mean in reality? How do we do it? So I'll just give you 2 clear examples, because for us, stewardship is about impact. So as you can see on the stage here, we have our Fearless Girl statue. And our Fearless Girl initiative was really about driving gender diversity at the board level. And so what we effectively did is we focused on 700 companies that had 0 women on their boards. So 700 companies across the US, UK, and Australia that had 0 women. We reached out to those companies to let them know, why we consider gender diversity to be an issue. So kind of two core themes to that. One, it kind of makes sense to have diverse boards, and women are 50% of the population, and they should therefore be there. And you'd be surprised that there were companies that kind of question that. And the second point is that there is an economic benefit to gender diversity. So there are a number of studies that demonstrate that boards which have women on them outperform boards that don't. And so through our Fearless Girl campaign, we ended up voting against the nomination chair at 500 plus companies that did not, as a result of us reaching out to them, appoint a woman to the board. 155 companies subsequently appointed a woman to the board as a result of us reaching out to them. And approximately 34 companies told us that they would be looking to appoint a woman to the board during 2018. So clearly we've got work to do. We want to reduce that 500 number, but we're also expanding our Fearless Girl program to new markets. So we're expanding Fearless Girl to Japan and Canada. Another example will be climate change. So as a global investor, we can see that European oil and gas companies are beginning to disclose more on climate change. They're beginning to talk to us about carbon pricing. They're beginning to talk to us about how they're integrating greenhouse gas emission targets into CO compensation. When we speak to US oil and gas companies, we notice that there's a gap in that kind of disclosure. And so using our voice and our vote, we're able to engage with US oil and gas companies to say to them, well, look, just because you're not facing the same regulatory pressure as European oil and gas companies, the physical and transitional risk of climate change is still relevant for you. And a great example of that is that we had a US oil and gas company which basically started to disclose more on climate change. And then they came back to us and told us, well, hold on a second, we're seeing more European investors investing in us. Why do you think that is? And our response was, well, that's because you're disclosing more, and therefore investors are better able to understand the particular risks around climate change for your business. But we understand that our clients also want to have some impact on what we do. And so whilst we don't necessarily believe that funds should necessarily be directing our voting, because not all of our clients think the same way about certain issues, we do believe that there is an opportunity for our clients to impact on our stewardship strategy and program. And that's through our kind of reporting to them, in terms of what we've done on their behalf. And that's the point upon which they can then, give us feedback on what we're doing.
Thank you very much. And just sort of looking at the, you've spoken about climate change and gender diversity, sort of two of the big risks that, people are talking about and that you're engaging on. Are there any, what one would call sort of under the radar risks that, if you can give our scheme members in the audience a little bit of a sneak peek, what do you think are the risks that are coming up over the next 1, 3, 5 years that people aren't necessarily talking about as much as they should be?
Sure. So I think big data is a key risk. I think a lot of companies, a lot of sectors are focusing on this. So the pricing of data, data privacy, cybersecurity is a well-known risk, but it's increasingly becoming one for companies. So it's not enough necessarily to have a board director that has responsibility for cyber. You need to have reporting lines into the chief technology officer, for example. But I think probably big data is the key risk that I look at. I'm increasingly looking at when I speak to companies.
Okay, thank you very much. And now over to Kaisie for the DC scheme perspective.
Thank you. It's lovely to be here this morning to speak to you about this topic. It's something that I'm really passionate about and really enjoying the work that we're doing with State Street on our DC pension fund, but also recognise that as an asset owner, as the DC pension fund provider, we have slightly different responsibilities in that space. And I want to touch on some of the things that we're considering at the moment and some of the challenges that we're facing. So when we're looking at stewardship across our DC investments, and in particular across the default fund that we're offering to customers, we're doing it keeping in mind that really these customers are expecting us to be taking care of their money so that they can have a benefit in the future. And that for most of our customers, and certainly our research shows this, they don't actually have that much of an understanding of where their money is going beyond the fact that they're contributing towards a pension and that the pension provider is doing something with that. And they're also quite clear with us that they see that as our responsibility. So it's not their responsibility to design the investment strategy. That either sits with the trustee or it sits with the pension provider. And for them, looking at whether they're contributing enough is really the big question. So that then pushes the responsibility on to the provider and also to the trustee. And what we're looking at is, if we're limited when we're talking with different asset managers about how we might influence engagement strategies because we're in a collective investment, how might we think about stewardship across all of the funds that we're invested in? And how might we recognise the companies that pose the biggest risks to us or to our beneficiaries? And then what might we do about that? So for us, we've done a big data exercise and looking across all of the funds that the default fund invests in, we've brought up the top 20 companies. And if your default fund is anything like my default fund, then you're probably heavily skewed towards the UK. And probably underweight America and emerging markets. And so your top 20 is going to look remarkably like the top 20 in the FTSE, right? So without naming names, we probably know who that is. So then looking at what kind of risks do we face and what kind of changes do we see happening over the investment horizon of our customers. So our average customer age is 38. And if they're lucky, they'll get to retire when they're 60, 65, 68, I don't know, 78 maybe by the time they get there. So we're looking at a 20 and 30 year investment horizon. And if you've been listening to the IPCC reports, you'll know that we don't have 20 or 30 years. Apparently we now have 12. And so we're really expecting quite significant sectoral changes over this time period. And so for us, it's saying, what kind of sectors do we think we've got the biggest exposures to? Where do we have the biggest risks? And then what are those companies doing about it? And how can we work with other asset owners to find that out? So it's not normal that I would go in and speak to these companies directly. Robert would be doing that on our behalf, and that's something we've delegated. However, as an asset owner under the Stewardship Code, you still retain that responsibility to make sure that Robert's having the conversations that you want to have on behalf of the beneficiary. And so although I can't direct Robert, what I can do is work with other asset owners. So this year we joined the Institutional Investors Group on Climate Change. where we can work alongside other asset owners who represent £23 trillion, which is a number my children didn't realise existed. It's quite a lot of zeros at the end of it. And we can work with them. And the Stewardship Code absolutely allows for this, for the smallest asset owner to work with the largest asset owners and say, where are we most concerned? What do we want to know from these companies? We are the owner. So how are they facing into this future that we think will change remarkably? And what are they doing about it? So where we see that we can undertake more stewardship activity is really holding companies to account. And the way we might go about doing that is through shareholder resolutions or open letters or asking questions at AGMs. So that activity will sit alongside the activity that's undertaken by asset managers, but it's something that's unique to an asset owner. And it's also something that's informed by the conversations that we're having with customers so that we can be really clear on what are the things that are important to them and that we're reflecting it in our activities.
Thank you very much.
You're welcome.
We've spoken about all the different regulatory changes that are happening. Of course, one of the big things, you've mentioned the Stewardship Code, and we're expecting that consultation to come up in December. That will be a key opportunity for asset owners and others to try to influence how it can be most effective going forward. As an asset owner, Kaisie, what would you like to see happen to the Stewardship Code to make it more effective?
Oh, this is a big open question, isn't it? Okay, and we didn't get to know the questions beforehand, so I didn't have a prepared response for this one. I think what I would like to see is that there is more definition of what each of the parties are responsible for. So what I worry about is not that I'm not doing my job or that Robert's not doing his job or any of that. It's that there is a space between. Right? So if I'm doing this bit over here and the customer is doing this bit over here, what about the bit in the middle? Right? And that's where things fall through and get missed. And so if we can be really clear on those spaces in between, so that we can be clear about how far we're supposed to go, I think that would help. And I think that was the theme of what came out with the Law Commission and the DWP and hopefully the FCA if they can finish consulting and have some rules. So it's really about clarifying responsibilities and making sure that we can then live up to those expectations.
Thank you very much. Lovely, thanks. So we've had a few questions come through on the app, so thank you for those technologically literate people in the audience. I look forward to looking through those. Do we have any from the floor? Yes, you, sir. And if you could just say your name and where you've come from as well. Yes, there you go.
Okay, thank you. That was really interesting, enjoyed that. And so my name is Brian Henderson, I'm from Mercer. And so here's the difficulty, I think. You have 94% of people in the UK default into their pension arrangement. They go into default, 99% if you look at master trusts. People in the UK are just not making decisions at all. So the onus kind of falls on to people like yourself to make sure the defaults are right, and we all think this is the right thing to do. So if I think about how we consume and then how we invest, so if you put 100 quid a week, if you're lucky to spend £100 a week in your shopping, you're likely to think about fair trade, organic meat, farmer welfare, etc. You take a lot of time over what you spend your money on. When it comes to your investment, you get someone else to do your shopping for you. So my question, I guess, is to the panel, I guess, to what extent do you think technology might change this conversation and dialogue rather than just kind of relying on providers to kind of sort it out?
Okay, right, thank you. Anne-Marie, do you want to? Yep.
Yeah, I'm happy to take that, to be honest. So it's a really good point. And I think technology will change a lot because I feel that it's particularly younger savers, millennials, that care a lot about the sort of environmental, social issues, which we perhaps all care about, but we notice it more in that generation. And I think the key is going to be technology going forward, interactive apps that engage savers. So I talked earlier on, I wasn't able to talk as long as I wanted to about the whole sort of issue of establishing an emotional connection with your money, but I think part of it is talking to members about the fact that their money is invested in real companies that do real things. So they, I think in the previous session I was listening to savers talking about, they didn't really understand where their money went, what happened to it. They often don't understand that it actually goes into companies that, say, build wind farms or maybe do stuff that's destructive for the environment or whatever. But there is there isn't that knowledge or that understanding. So having an app which they can readily access, which gives them that sort of information. I mean, I think already, for example, the NEST Responsible Investment Report highlights a lot of the work that they've done and sort of relates it to things which you can understand. But it's all about relating it to real world things and communicating that in a kind of visually and emotionally engaging way. And I think something like an interactive app is the perfect way of doing that.
Thank you. Anyone else?
Yeah, I'm a bit of a pessimist in terms of what can happen with technology. I think it would be lovely, don't get me wrong, we spend an awful lot of time, or certainly my children spend an awful lot of time on their digital devices, and it seems that you can pretty much do anything in real life on a digital tablet and it will take their attention. So if we could create some way to curate your own investment list the way that you can curate a playlist on Spotify, do I think they would use it? Yes. But I'm not entirely sure if it gets over some of the other problems around not feeling sufficiently confident in making investment decisions, even if the interface is easier. Or actually that feeling that it's not my job to do this, that there's a bunch of professionals that I'm paying quite a lot of money to, and it's their responsibility to do it. So I think it's great to offer up that digitisation route, but I'm not sure how it will be embraced. I think there's great kit out there that could make it easier, but it may not get us over that hurdle. Maybe 20% will engage. So I think the responsibility still stays with us to make sure that the default fund is fit for purpose and try and take a sample from our customers, find out what they're interested in, and if they're really interested in this stuff and really against some stuff, making sure that we incorporate it into the default fund.
Right, a question from this tablet, and this is probably for Robert first. Is stewardship enough to deal with ESG risks, or do trustees need to think about excluding companies from the portfolio on ESG grounds?
Oh, that's a tough one, thanks.
Here to help.
So, yeah, I think there may be times where you might want to exclude things. So I recently went in to see the British Medical Association, and it might be perfectly legitimate for them to say, well, actually, we want to exclude tobacco because we know that this has serious risk for us, and we're telling people not to smoke. So it would be absurd for our investment vehicle to then invest in those types of companies. But at the same time, through stewardship, we engage with companies as well. So if we take another sector like oil and gas, where some pension funds are beginning to divest from that sector and say, well, actually, we don't necessarily think we should be a holder, that does raise problems because, some oil and gas companies are beginning to invest in battery technology, they're beginning to look at renewables, and so you don't want to starve them of capital to do that. So I think both approaches can have merit. In our kind of business, we want to engage with companies, we want to identify the companies that are doing the right thing and pass on that best practice.
Okay. Thank you very much. Anyone else? No? All right. Oh, yes. Yes, Kaisie. Yeah.
Yeah, so on the point of exclusions, I do wonder, and this is with the greatest respect to both State Street and to Robert, seeing as they're the sponsor of the panel, right? So you're not supposed to be too contentious. But I do wonder if perhaps we've come to the point where pure passive investing has perhaps reached its day. I think there's absolutely a place right now for us taking a look at how we structure our investments, how we invest them. And there is this thing with passive investment where you're a provider of capital irrespective of what the company does. So it's like going along to the meeting and putting this stick in the middle of the table, but the person you're speaking to knows that you will never use the stick. So is the stick really a threat? Not really. So where we're seeing more decisive action from other players and that threat of, do you know what, if you still don't engage with us the way we need you to engage with us, we're going to remove capital, that becomes more of a mover. And I do wonder whether we're now at a point where we need to start thinking about tilting away from things or moving away from market weight passive, tilting towards higher ESG scores and really looking at some of the carbon footprint around our funds and questioning ourselves, at what point did we decide that a market weight was an appropriate investment strategy for the majority of DC pension savers? With the amount of money that's going to be going into DC pensions, we don't think a market weight investment strategy is appropriate for a defined benefit. So why do we think it's appropriate for a defined contribution? And I think we have some really big structural questions to ask around defined contribution. Why are we daily priced? Why do we have this liquidity premium when customers can't get their money out until they're 55? Why are we so overweight the UK? I think there's lots of big questions, of which stewardship is just one, around the structure of DC pension funds. I may have gone a little off topic.
And, we like a debate. It's really dull, I'm sure, for everyone. All the panelists speak to each other. Anne-Marie, and then we'll come back to Robert.
Yes, I agree with a lot of what Kaisie says, well, pretty much all of what you said. But I think that we're already seeing the asset managers coming up with really innovative new products, which are, tilting away. I know State Street's got, you've got a new product coming out very soon. And I think we're seeing it right across the board, which I think is really, really heartening, because I agree with you. I think pure passive has had its day, and these things need to be addressed. And I think you were totally right in your comments before that, all these things need to be addressed, and they need to be addressed on the default fund, because that's where most people go. I think there need to be ethical fund choices that people can find on a website. If they're navigating, they can find their way there. If there are particular areas they're interested in, they want to get into impact investing. But I mean, the default has to be, I think, responsibly invested and properly integrate ESG and have good, robust engagement and stewardship as well, a kind of engagement with teeth, I think. And stewardship. So that's really, really important. And I think going back to the point the gentleman made earlier about the sort of technology, I totally agree with what Kaisie was saying. There's a lot to be done on financial education and so forth, and you obviously have to structure those apps really well. But I think the key thing is if you get people more engaged on these sort of issues, then hopefully you'll see contribution rates going up, and that's the kind of purpose of it. So I think everything that you've said also needs to be done as well by the pension provider, but it's sort of, there's loads to be done in all the different areas.
It's definitely enough to keep me in a job for like the next 20 years. That's the important
But the big
thing.
question here, surely, are you going to do this as asset management companies at the same price for passive as you do for active? Because then we're going to be hurting the primary objective that people are putting money into pensions, and that is for good outcomes and for later life looking after themselves. So I understand this, but it's a huge change, and the asset management companies have got to step up to this. You can educate all that you want, but unless the asset management companies step up to this, whether it's saying goodbye to passive or finding a very cheap way to move companies out when they're falling out of things, or move companies in when they're doing well, I don't know.
Yeah.
Rob,
So-
do you want to quickly
so I just
respond?
want to-
And that's,
Sorry, but
no.
so I just wanted to respond to the kind of point about passive and do we have a stick? So I think that the point about it's not about passive or active; it's about impact. You can be a passive house and do nothing. You can be an active house and do nothing. So it's what are you doing with the responsibility and power you've been given by your clients. And so everything we do within our stewardship program is about impact. It's about making companies that aren't good on ESG better, but that takes time. And so the idea that you can kind of just talk to a company once and they do what you want, as much as I would love that to happen, has never happened in the 10 years I've been doing this job. So I think what it's about is understanding that this is a long-term business, and that when we engage with companies, it's a long-term relationship. And I think that companies understand. So the fact that we can't divest doesn't mean that companies don't listen to us or want to speak to us, because we have the vote, and that's a very powerful tool. And companies don't like it when you vote against them on stuff. They really don't. So I think that we do have power, we do exercise it, and because we have that long-term relationship, we are able to move companies to the position that we want to get them to. But it takes time.
Lovely, thank you very much. And we've sort of run out of time there, but thank you to the audience for asking questions through the app and also in person. We really appreciate that. I spoke about the Stewardship Code. The PLSA is running a consultation on the code at the moment for scheme members. If you've been delighted, amazed, appalled by whatever you've heard, if you're not vaguely interested or not interested at all, let us know your views. It will help us shape our response to the Stewardship Code consultation. And then just before you go, again, app time, interested to see whether or not our fantastic panelists have changed your mind, for better or for worse. You can feel the tension increasing. Right, do we have any? About the same. More no? Ooh, no. Look at that.
Nobody
very
doesn't
good.
know.
Oh, that's brilliant. I didn't see. Oh, well, thank you to whoever that was for proving Kaisie wrong. Much appreciated. Ah, very interesting. Well, you know, these people are here, I'm sure, for the rest of the day. I'm here. If you have any further questions, please do get in touch. But before that, please join me in thanking our wonderful speakers for a really interesting session.